taxes are something that have and we're going to have forever, but please do yourself a favor. Don't start making business decisions based upon the tax benefits. It makes no sense ever. It never ever makes financial sense to do that. I gave a class yesterday to a retirement group at the University of Georgia on taxes. And they were asking me a lot of questions. Well, maybe it's the time for me to buy another rental property right now because I can save, more taxes. That would be the last reason I would ever consider buying another rental property right now. So ignore the tax consequences for any business decision you make, but let's maximize the tax benefits we get once you do enter into a decision to do something. Let's save as much as we can. But don't focus and dwell on the taxes. It happens a lot. I know some of this stuff sounds basic, but I've learned from experience to say this stuff over and over again because the basics always come back to matter, okay? Now, one more that's not on here, and I promise the rest are. You all are probably somewhat familiar with an IRA versus a Roth IRA. Now here's something that happens. If all of you that I've spoken to so far are already employees of a company, and you probably participate in their retirement plan, and we always say if you are an employee of a company, you should maximize your contributions into their 401k plan to the extent that that company matches. That's step one. That's free money. You cannot leave that on the table. The next level of retirement that you should participate in is a Roth IRA. But there's income limitations. If you are going to participate in a Roth IRA, you can put up to $5,000 a year into a Roth IRA, but there are income limitations. Once you make over a certain dollar amount threshold, which you don't have to write down because I've given you every possible chart necessary on all the different thresholds that apply, and it's somewhere like over $150,000 a year if jointly, but you wouldn't be able to make that Roth IRA contribution because you get phased out. However, there's a little window that's coming up that I'm here to remind people about. It's called the year 2010, and that's getting very close. This is what is an amazing planning tactic that's getting more and more applicable. What you can do is you are not going to be able to make an IRA contribution if you are a participant in a 401k plan because that income limitation is very low for most people. But you can make a non-deductible IRA contribution. Let's say you really want to put away more, but you don't want more in your 401k and you love the Roth. The difference between an IRA and a Roth, by the way, I have to cover that very quickly. An IRA, when you put the money in, and just like a 401k, is with pre-tax dollars. In other words, you get a tax deduction. A Roth, you do not get a tax deduction. The money goes in, and then the growth, which we hope we have growth again someday, is free forever. So the money you pull out of a Roth at retirement, 59.5, you can start pulling the money out. You never pay taxes on that money ever, ever, ever. Well, in 2010, Bush eliminated the income limitations. You can, in 2010, you can convert any amount you want from an IRA into a Roth. And that conversion now, to convert from an IRA into a Roth, has an income limitation. If you make over, married filing joint, over $100,000, you can't do it. And when you do convert your IRA to a Roth, you have to pay taxes, by the way, on that. You pay taxes on the amount that you're converting. For 2010, those taxes can be spread over 2 years, and there's no income tax limitation. Great thing to take advantage of is a non-deductible IRA right now if you want to put more away and get it into a Roth, because that for sure is going to be slammed shut down after 2010. So is a lot of other things, I'm afraid. So our planning window is, I don't know what's going to happen. I just know there's going to be a heck of a lot of change coming up.